So, welcome to our third formal here in the monastery of Über and all over the place. So, this time we have a very topical session. We are talking about structural change in real estate markets and the regulatories can affect that. We have high-class speakers. We have a very important session at the end. And in between, we are talking about regulatory changes and challenges. Can tax breaks or subsidies have an impact on affordability or not? I'm Tobias Dichtl. I'm the academic director of IREBS Immobilienakademie. I am the chair of real estate at the University of Regensburg, and I'm here with my colleague Michael Zingel.
Hello, everybody. Thank you for joining us. Our third Forum of Excellence. My name is Michael Zingel. I'm the head of studies, and good to be here today. We're starting today with a lecture of Tobias Dichtl and Simon Krause, who will talk on the impact of working from home on office real estate. Tobias is holding a PhD and is currently senior director at Colliers, Germany. He is co-head of the Market Intelligence and Foresight Department, and he has graduated from Bayerische Julius-Maximilians Universität of Würzburg, and he is today joined by Simon Krause. He's PhD candidate and junior economist at IFO Institute of Economic Research, and he is a graduate in digital labor and public economics from LMU Munich. Simon and Tobias, thank you for joining us. The stage is yours, and thanks for your first session of today's Forum of Excellence.
And for those who are still there, who want to join the conversation, discussion, please write your questions or answers in the F&A, the Q&A. Thank you.
Well, thank you very much for the kind introduction, and thank you for having us. I'll quickly share the screen, and then we are very happy to kick off the Forum of Excellence with our presentation. So if you can just give me a show of hands, Tobias and Michael, if you can see the presentation, fantastic. Okay, and Tobias is there as well. Well, also from our side, a warm welcome. Thank you for being with us, and thank you to the organizers for inviting us to present our study here. As you said, Tobias is co-head of Market Intelligence and Foresight at Colliers. I'm a PhD candidate at the IFO Institute, and for this study, we've combined our expertise on the economy and on real estate to look at one structural change in the labor market, which is this switch to working from home and the impact on office real estate. So we think this is very topical for today's conference on the structural changes in the labor market and structural changes in the real estate market. So I think without further ado, we can get started with our presentation. I'll do the first half of the presentation and then head over to Tobias in about 10 minutes. Our presentation will be around 20 minutes, and I think there will be plenty of time in the end for questions. So yeah, we're very much looking forward to getting your questions and get an interactive format started after the presentation. So the impact of work from home on office real estate is a very topical theme. It's very much debated in the media, and the overarching question for us in our study was, what actual impact does working from home have on office real estate? So basically, if we try to get a big picture view of this in the media, we see, well, on one hand, there is a debate about working from home. Will there be a return to the office? Is working from home here to stay? And if so, to which extent? And then on the other side, you have the changes and also the challenges in the real estate market. Some of them are based on interest rates, some structural challenges with rising costs of construction costs. But then there's also working from home, which particularly impacts commercial real estate. And so we want to get an idea of where we are in Germany and whether work from home does have an impact on on office real estate. So we thought it might be quite helpful to start with some numbers. And what you see here is a chart of the work from home share of employees in Germany over the past 12 years. And what you see here is that regular work from home has become the new normal for about 25% of German employees and actually 69% of companies. So the work from home share is defined as the proportion of employees who work at least partially from home. So this includes some people who work from home today on a Friday, but others who are also working from home permanently. The interesting aspect here is that you see, well, before the pandemic, there are some different measures, but all of them were pretty low at about 5% before the pandemic. And then with the mass experiment that COVID put upon us, basically the work went from the office to the home office. And we had a really high work from home rate, particularly during lockdown times in 2020 and also in the winter of 2020 and 2021. You see these in the gray shaded areas here in the chart, also the two peaks. But now the interesting aspect, and I would really like to draw your attention to that, is that over the past 2 years, after the pandemic had ended, and any pandemic restrictions got phased out, we still see a very flat work from home share of about 25-24%. So the 24% is the latest number from the Institute survey among 9,000 companies from all sectors of the German economy. And this is really remarkable how stable this has been over the past 2 years. And it's also remarkable just in terms of the level shift that we've gone from less than 10% before the pandemic now to 25%. So one takeaway here is certainly the increase, and the other takeaway is that we, despite all the talk in the media about some companies calling their employees back to the office, we do not see a phase out of work from home. We do not see the wide scale return to the office in terms of the 5 days in the office week. Now, maybe to distill some insights from research on what work from home actually means in some dimensions, I thought it might be helpful to give you a quick preview of this as well. So what research shows is that hybrid working from home works out pretty well for professionals who can work from home. So overall, if we split employees into 3 groups, we still have the majority of people who work full-time in the on-site. So think of those people working in manufacturing or also in services that do not allow for working from home. So those are about still 3/4 of employees. And then the 25% of employees who are partially working from home are split in 2 groups. So some of them work on a hybrid model. Those are in the middle. And then about 7% in Germany work full-time in their home office. And if we look at different metrics, we do see actually that for those people who can work from home, that a structured hybrid approach seems to be the way to go forward. So structured hybrid means coordination on some joint days in the office, joint days on site. Typically, this is like a Tuesday, Wednesday, Thursday schedule in the office. And then 1 or 2 days at home, mostly like we see it in our service, it's mostly a Monday or a Friday. Typically Fridays are the most popular days for working from home. In terms of satisfaction, structured hybrid wins out. So it combines basically the flexibility of working from home with also the benefits of being together in the office. That's also a reason why we do not, like if a structured hybrid model is well implemented, studies suggest that there is no loss in productivity. For companies, in terms of real estate, rental costs of the office, it actually means that you'll have still a very high peak utilization of the office. And thanks to this high peak utilization, the savings on office space are limited. And one other advantage of implementing working from home is that companies can draw from a broader talent pool. So we see that in Germany, the average commuting distance to the workplace has increased over the past years, which means that both people have out-migrated from cities, but also that companies are now recruiting from a broader talent pool. Now, all of this here is not like a one-size-fits-all model. It's about trade-offs. So what I would like to get across here is that there's no perfect solution to how companies want to implement or should implement work from home, but that there are some trade-offs on the way that need to be thought about and need to be traded off against each other. Now, getting to our study. So what we've done is that we've combined the data from the Institute on working from home with Colliers data on office leases in the top 7 German cities. So we've looked at those cities over a long time period, and those top 7 cities in Germany are Berlin, Hamburg, Munich, Cologne, Frankfurt, Stuttgart, and Düsseldorf, as you all know. And in the Colliers database, we have about 35,000 office leases with lease level information on office size, rent, location, industries. And in our IFO data, we do have information on working from home at the industry level, on underutilized offices, and also on planned office downsizing. What we do in our study is we combine these data for the first time, and thereby we're able to generate some new insights as to how work from home impacts office real estate. In addition, Colliers has conducted an internal survey with qualitative evidence of altered user requirements for offices based on some selected reference transactions that will provide further anecdotal evidence on how work from home changes demand for offices. Now, to start with one macro view, in the past, there's been a strong correlation of the demand for office space with the IFO Business Climate Index. We see it here. Those 2 lines, the IFO Business Climate Index with the 4 quarters lead in red and the newly leased office space volume in blue. And what we see here, like we've correlated it against each other until the end of 2023, we do see that the IFO index does not suggest a rapid recovery of the office market. So we see that the volume in the office market, the leasing volume, has fallen down to levels that you last saw during 2020, during the pandemic, and at least our correlation here with the IFO index does not suggest a speedy recovery of the market. At the same time that the office leasing volume has come down, we've witnessed an increase in vacancy rates. Vacancy rates have risen from less than 3% in 2019 to almost 6% in the last quarter of 2023. So all of these developments go hand in hand and also illustrate the dire situation on the office market right now. And the question is now, which impact does work from home have on this? And here I would like to give you a quick overview of what we find in our study, and then Tobias and I will go into further detail here. So the first aspect that we want to highlight in terms of the impact of work from home is that there is permanently more work from home since the pandemic. So hybrid work schedules have been established in many industries, leading to lower office utilization and also prompting plans and companies to downsize office space. This is particularly the case for larger corporations with many offices. Secondly, we see a decline in demand for office space, but at the same time, and this is very interesting, an increase in rents. So there's a correlation. It's not a causal relationship, but it's a significant correlation between more working from home in an industry and smaller office spaces, but at the same time higher rents. So this indicates that demand shifts from the old-fashioned lower quality offices to smaller but more flexible and more work from home amenable offices. Tobias will go into further detail here. And the third point is also very interesting. We do not see a changed location preference. So prime locations in city centers remain in high demand, despite or maybe also because of work from home as an incentive for employees to get back to the office. This is in strong contrast to what we see on the residential real estate market, where people have left the cities in the years 2020, 21, 22, and where we see stronger increases in rents and prices in the periphery of cities than in the city centers. Now, what we see here is the relationship between companies' unoccupied workplaces due to work from home and the plans to reduce office space. So we, at the An-Institut, we asked these 9,000 companies in about 50 industries about their, not only their work from home, you saw that on the one of the first slides, but now also whether they have many unoccupied workplaces due to work from home. And this is the case. So we see quite a bit of variation here, but there are quite a lot of unoccupied workplaces due to work from home. And at the same time, if we ask these companies whether they would plan to reduce office space due to work from home. And the interesting phenomenon that we see here is that these two metrics are positively correlated. So what you can draw as an insight from this graph is that basically for an industry with about 20% of unoccupied workplaces due to work from home, 15% of companies in these industries plan to reduce their office space. And what we illustrate here on the right with the arrow and the blue box is that in industries with a high proportion of office space, up to 40% of workplaces on site are not occupied due to work from home. So this empty desks phenomenon is particularly an office phenomenon. And companies plan to downsize their office space then by even up to 30%. Going forward, we now face the challenge for our study, what the long-term impact of work from home will be on office space and how we can model this. So this will not be an immediate impact. Some of it will already be felt, like we see the current market situation, we see increasing vacancies. We do already see some changes since the pandemic, but most offices are on a lease for about 7 years. On average, some a little shorter, some a little longer. So this effect will take some time. And for this purpose, we try to forecast the expected reduction in office space demand due to work from home. And we think that this will be affected by two factors. The first factor for office space downsizing is the scope of affected office space. And the second factor is the scope of the space reduction. So I'll go through it. Overall, we expect in our most likely scenario that there will be 12% less office space in the long term. Think about the long term as a horizon until about 2030. When we assume that there will be a 60% impact, or 60% of office space that will to some extent be affected by work from home, and on average, a reduction of this space by 20%. Now, how do we get to these numbers? I'll start with the scope of affected office space. So we believe that approximately 60% of office space will be affected. This is typically office space in larger offices and in larger companies that have higher work from home rates. And what we believe here is that the structured hybrid work arrangement that we see winning out with coordinated days in the office and days at home limits the scope of space reduction due to the high peak office utilization rate. And when it comes then to the second factor, the scope of space reduction, we believe that there are two forces at work that go in opposite directions. So one force will be the share of space reduction and the other force will be the share of space conversion. So what do we mean by this? We mean here that there will be some space saving possible. For example, when companies introduce desk sharing policies, let's say with a ratio of 0.7 desks per employee, then we'll have scope to reduce office space by about 30%. But at the same time, the nature of the office and the purpose of the work there in organizations that have a hybrid work model changes. The days that will be joined in the office will be used a lot for communication, for mentoring, for meetings, for problem solving. And for that, you need different types of offices. So it's less about the desk. It's more about having joint areas for meeting space, for example. And this is why we believe that up to 10% more space will be required, for example, by converting workplaces to meeting spaces. So this leaves us with the 20% reduction on average. Now, these numbers are not pinned down and not exact. We do not claim that it will be a 12% impact at the end of the day. We rather believe that we are in the most likely scenario, we'll end up somewhere around there. But there could be also, under other assumptions, there could be also minor office downsizing. We try to indicate the lower bound here in scenario 1, leaving us with total office space downsizing of about 4%, and also the higher scenario with major office downsizing, if we believe that even more space in these offices is affected, and that the scope of space reduction will be even larger, than we can even see more than 20% downsizing. But in the most probable scenario, we believe that will be somewhere around 10 to 12%. And with that, I'll head over to Tobias for the second part of our presentation.
Yeah, thank you, Simon. Let's dive a little deeper into the data we analyzed. So what you can see here is the development of subleasing space. We tracked over the top 7 cities over the last couple of years, and we highlighted the start of the COVID pandemic with the red dotted line here. And you can see a significant increase. So we started off at around 2% before the pandemic hit, and we are right now roughly about 7 to 8%, depending on what quarter we look at. So we have a significant increase that can be attributed in parts to economic factors, so macroeconomic uncertainty, companies trying to downsize due to costs of rent and stuff like that. But it can also be an indication for office space that's coming to the market because it's no longer needed because of working from home. Because as Simon mentioned, we have an average lease term of about 7 years in our sample. So it's just not possible to reduce your office space right now. You have to wait until the lease runs out, and that's one part we can see here in the data, you start to sublease some of your space to other companies to reduce the rents while the lease is still active. On the next page, if you look a little deeper in kind of what Simon already mentioned in the introduction here, what you can see here is the changes in average office space per deal, so the average office space per square meter, and on the bottom you see work from home rate per industry, and we can see a correlation here, as you can see by the red line. So industries with a higher work from home rate or a change in the working from home rate since 2019 seem to have limited their floor space per deal. So that's an indication for what Simon already mentioned, that companies are starting to lease less space per deal when they show larger working from home tendencies. And on the next page, we see another chart like that, just the other correlation Simon already mentioned for office rents. And here it's the other side around. So we see an upward trend. So companies with a higher change in working from home rate since 2019 seem to be more willingly accepting higher lease terms. So that's just a positive trend. That's a lot of factors going into that potentially, but the correlation is okay. So we can see the positive trend, and that's one indication for, we had a lot of talks and indications and sentiment indicators before we did the study. So companies reduce space, they're happy to pay higher rents for better locations, for better office quality. And that's the first time we can see in our data combined with the IFO data that there is indeed a positive trend here that's also significantly on the statistics side. If we jump into more anecdotal data, as Simon already mentioned, we also did kind of a survey in-house at Colliers where we asked, or we did roughly 40 interviews with senior consultants in our team who in the last couple of years accompanied companies while doing new leases, especially larger companies. And we asked them a number of questions on, what requirements were in the focus for the tenants during the lease term. And we separated that. You can see here all lettings, then pre-COVID lettings and post-COVID lettings. And you can see some interesting shifts here. So we highlighted new work capacity. That was a topic that was not really relevant before COVID hit. So a lot of people talked about it, but it was not the main focus for a lot of companies when they did new leases. And if you look post-COVID, that significantly changed. So it's a huge factor in all our discussions we have right now, the new work capacity, and that's more relevant than other factors, as you can see on the next steps: digitalization, sustainability. Also, two topics which are really present right now in a lot of discussions and also in the media, but that's not what the tenants are most looking after. So it's the new work capacity which really dominates the discussions right now. And of course, and that shouldn't be a surprise to anybody, but we didn't see a huge shift here, it's location and surroundings. For real estate side, of course, that's still a very important and major topic for our tenants. If you look at some other more in detail themes here, new work capability, what does that mean, and what kind of criteria are most relevant here? And you can see the two top items: floor plan flexibility and communication zones. So those were topics which were relevant before COVID. You can see that here on the left, dark blue and medium blue lines, but it's really more important since COVID hit. So floor plan flexibility is that you can adapt during your lease term to different concepts, to different needs. If you have to kind of move different apartments, or you have to have new communication zones and stuff like that. So flexibility of a floor plan is really important right now. And other things you can see on the third step, that should be quiet zones. Sorry for the typo. That's also another thing. If communication zones, quiet zones. So you want the company, or the companies want more flexibility, and also they want kind of both the community side and the quiet side concentrated work. And we see that on the next slide as well. If we look at kind of what office concepts are more sought after, and you can see here open space and shared workspace. Those are two themes we really see right now. So a lot of companies are looking at that, because with the open space concept or shared workspace, you of course get a lot of flexibility, which you don't have if you have a number of individual offices. So if you have individual offices separated by walls, you don't have the luxury to just change that on the fly. You have to do a significant work to kind of open that up. And if you have an open plan, open space, or shared workspace, however you want to call it, you are way more flexible, of course. And we have seen in our discussions with tenants, and that's an ongoing trend, that those kind of themes are more relevant right now. So that themes, it's a limited number of interviews, of course, so it's more anecdotal evidence than really significant statistical analysis, but it kind of underlines the trend we see, and it's also a trend we see in current discussions with tenants, and that's also something we see in media reports and stuff like that. So open plan, more flexible offices, that's something that's really important for a lot of tenants right now. Another thing that's discussed pretty often is the question of what about locations for offices, right? So are central locations still thought after? Is it a suburbanization trend like we see in residential, or we see in parts of the US market, for example? So the theory would be that, okay, now the CBDs are not so much sought after because you can be nearer to your home if you moved suburbally and you can work there in your office. The evidence is not really clear right now. It's a limited time period we have since COVID hit, but what we can see right now in the trends, and you see that in the dark blue line here, is at least we don't see a shifting trend in the CBD rents, right? So we see still a significant upwards trend in CBD rents. CBD offices, especially modern ESG-ready central offices, are very much sought after. Rental rates keep increasing. Also, right now, we still see significant increases ahead of us. So that kind of underlines that tenants are still looking at CBD locations. For the other kind of submarkets, if you look at suburban areas, wider metro area, it's not that clear. So the trend is still positive in most of the areas, but it's not as strong as in CBD locations. So that could be indeed an evidence that, okay, as well. So tenants are looking for a modern space, not only a smaller space, but also in more central locations, because you can get there by train, by car, by foot, and stuff like that. And that could be one side we see here, but we have to analyze that wider and looking forward, because as said earlier, a lot of the shifts we expect will materialize over the period until 2030, because lease agreements are still running and companies are kind of limited by what they can do right now if they have a lease that's running for 5 to 7 years. So if we now take all this data and get a little outlook here, what we expect for the office market. For number one, market environment will remain difficult. So the macroeconomic factors in Germany right now are not really positive for the office market. We don't expect a rapid recovery on the economic side. We don't expect a rapid recovery from work from home rates. So that's basically stabilizing. So that will lead for an office demand, which will be on a lower level on average than we have seen before the pandemic. That's something that we expect, and we don't expect to get back to the high levels we have seen in 2018, 2019 before COVID. So the office market has to adapt to structural lower demand levels. What we also expect and already see is working from home changes office space requirements. We have seen that in the survey we did. We have hybrid schedules, which we have to adapt to. So space demand shifts from offices to meet requirements for new work arrangements. That can be quiet zones, that can be meeting zones, that can be shared offices. And that's something, of course, a lot of tenants, if they sign new leases or are reimagining their office space, are currently working on. And of course, if tenant demands shift and market environment shifts, that has implications for investors, right? So office markets are currently not really seen very positive on the investor side. If you look at sentiment indicators and all the other surveys we see. And we have a lot of factors coming on top of the work from home discussions, of course. We have the insolvencies we have seen over the last couple of quarters. We have seen a significant price corrections in the office market due to high refinancing costs and cap rate expansion. And of course, looking forward, we see a lot of obsolescence risks because not only will work from home change office markets, but also ESG requirements will change significantly what you can do with your offices and how much you have to invest. And that will lead to significant capex, which investors have to account for. And that, of course, has then implications for values and returns. So that would be the quick summary of our study. And now happy to start the discussions and take questions.
Simon and Tobias, thank you very much for your insights. I would like to give the chance to our audience to write some questions in our Q&A section. So feel free. In the meantime, I would like to start with the first question to you both. I think this is a very emotional debate if there is a reduction of the space, because several market participants thinking that the social area will increase. So there's no net effect on decrease on office space. Maybe you can point that a bit out for us.
Yep. So the discussion, of course, is ongoing. So if we look at the evidence we see right now from our business side, so I'm just gonna answer it from the Colliers point of view, and Simon, you just jump in after that. We basically see no new leases done without a space reduction if you look at tenants above 2,000 to 5,000 square meters. So if you look at smaller tenants, of course, if you have 500 square meters of office space, there's not much potential to reduce that. And you, of course, need some amenities and some recreation zones and stuff like that. So that could be a net neutral effect there. But if you look at larger tenants, if you look at 10,000 square meters, especially corporate clients, where you have also kind of fixed working from home regimens, which are kind of agreed between company and employees there, we see a significant effect. So that changes from industry to industry, of course, and from sector to sector. but the evidence is there that especially larger tenants are reducing their space.
Thank you very much. Another interesting question comes up is you point out the impact on productivity. You point out on satisfaction in your first slide, and also the impact of industries. So did you combine in your studies productivity and branches? So are there any impacts which branches who benefit from work from home are the links to productivity of these branches?
So thank you for the question. On purpose, we did not go down into this productivity debate because we see that this is a very contested debate, and there are great studies being conducted right now by a lot of people who really focus on this productivity effect. So what we see in terms of economic research is for professions where you can measure output really well. Work from home does seem to be okay in terms of, or almost flat in terms of productivity. But it all depends on how you establish work from home in your company. So there seems to be an advantage for hybrid work from home, particularly if you structure it well, that you have joint days in the office to reap the benefits of being together face to face, as well as the flexibility and higher satisfaction on the employee side on the days at home. Now, the productivity data is notoriously hard. It's notoriously hard to measure productivity in the economy. It's usually a residual. And so it really depends on the professions where you can measure it well. I think there's still a lot of research to be done, and also research to track that for office workers better than it's being done right now. But what I showed you before was kind of the current state of the research.
Thank you very much. Again, the question in our audience, as you can see, no questions so far.
I have some. Yeah, yeah. So you pointed out that rents still tend to move up, and particularly in the CBDs. But we have several effects. We have not only work from home, we have also a sustainability movement, and tenants and investors are currently searching sustainable products. So these are usually found rather in the inner cities because it's better turn up to do that in the more expensive locations, because it makes more sense to renovate in expensive and more logic to get a certificate in more central. So can you disentangle these two effects, the work from home, let's say the efficiency or whatever you name it, we search better reachable offices from the sustainability issue when it comes to rent?
We didn't do that here in the study, and it's tricky to do that. We are currently looking at our data and try to kind of get a better grasp of this aspect. So we're trying to separate our lease deals kind of by different KPIs or different criteria, and try to filter for ESG, location effects and stuff like that. That's an ongoing project. It's hard to do. Because it goes hand in hand basically for a lot of companies, right? So they're moving to central locations, or they remain in central locations. They reduce their kind of floor space. They keep the total rent more or less the same. If you reduce by 20% your space and you increase your rent by 20%. But the ESG topic, and also kind of building costs for new buildings that are a factor for increasing rents. So it's hard to kind of untangle those factors, but we're trying to do that, but we didn't do that for this study here.
I was a little bit surprised when you said that people are reducing or planning to reduce the office space, and still there's only one smiling sun in the second your basic scenario. So why weren't there more sons when it comes to saving rent in a scenario? Shouldn't it be somewhere in the middle? Sons.
That is a great question. I think there could be half a son added in the hybrid work from home schedule. But I think the point that we try to make here is that work from home will not be the end of the office market, particularly if you have a structured version of work from home where people still come to the office on the same days. This will still change the nature of work and probably on average also reduce the demand for office space, but not by as much as full work from home would do, because there are some companies, to be fair, only very few that went completely virtual during COVID, or new companies that are now founded without an office as basically work from home companies or work from anywhere companies. But if we look at the market as a whole, this does not really play an effect. So that's why rental costs for the potential savings on rental costs for hybrid work from home models are limited. Also, if we factor in the increased quality that is desired for these offices, so smaller offices but with higher rents per square meter leaves you with on average perhaps a little less, but close to the previous office building.
Yeah, that brings me to my last question, because we have also one in the chat. Given that there is a difference between complete work from home, hybrid model, and present model, what could be a answer of the regulatory bodies? Because it could be that the regulatory bodies are afraid of companies outsourcing costs to private households, so taxing them implicitly by leveraging their cost on the private rents. So do you have any views at Über or at Colliers? What could be a possible reply of the government looking at a potential outcome of the situation, people living further from the CBD, commuting, and making, let's say, office work at home?
Happy to start, and then Tobias, you jump in. So, the political implications of this debate are very, I think, still very open. If there should be some regulation or not. Right now we have the situation, as you said, that people have moved to their home offices on some days in the week. We actually see in another project that people are moving out further outside of the city. We see that on average, private households demand more space, perhaps an indication for an additional room that can be used as a home office then. And that is something that, of course, is a private cost to these households. A private cost that they can expense for their tax returns. And if we look at the utility on a household level, well, they might have higher costs if they need more space at home, but they're also moving out of the city, so rents go down a little bit, and they benefit from more flexibility and from saving commute times. So it's not clear cut ex ante if this is a negative effect for households. But I do see the point that for some companies it might be this might be exactly what's going on, that they shift some of their office rental costs to the private households. But so far people seem to be happy, and this entire phenomenon of work from home, I think one explanation why we still see it is that we live in a situation right now in Germany where we're in an employees market. The labor market currently has a lot of leeway for employees, and they demand it, and companies, if they seek talents, cannot really afford not to offer work from home at all.
Okay, thank you.
Thank you. Then we have two questions, one from Reza and one from Sebil. Reza is questioning on the amortization, but I think you guys see the question also, so feel free.
Yeah, that's the big question, I think. real estate investors or property holders are currently facing. So of course we see increasing demand for capex, not only for working from home but also for ESG modernization and other measures you have to take. And the question, of course, is can you get your money back on that kind of thinking, especially right now when financing costs have increased substantially. So a lot of times, if a real estate investor is looking at their properties right now, it's really difficult to see a clear cut and easy way to answer that in a positive way. So we see a lot of risks for especially older buildings or for not really good located buildings to face significant declines in value, or to see significant demand for additional capex, which you cannot get back over your rentals, at least in the short to medium term, because the upside we see on rental levels, if you go outside of the CBDs, between really older stock or medium stock to high quality stock, is not high enough to kind of financially get you back your investment. If you look at CBD locations, it's easier to see the way to financially sound investment, because we have seen the significant rental growth for modern high quality offices over the last couple of years. So if you have a grade B or grade C building in those locations, and you have a capex program or a significant investment program to get that up to the kind of modern new build quality level, you have a significant upside in your rents, and you can get, of course, a lot of your investment back and get into positive territory. But for a lot of older stock and older buildings, that's a really tough question right now to answer. And we see there a lot of problems facing holders or investors in those kind of markets and properties.
Thank you very much. And then coming to the second question.
Maybe I start as well, Simon, or you want to start?
Go ahead.
Yeah. So interestingly, we don't see a large increase in short-term leases right now. So we have another project where we're looking at lease lengths. I'm going to do an update on a study we did a few years ago, and we don't see any major shifts like there. So that can be in parts attributed to kind of the supply-demand characteristics, especially for modern offices. So we have limited stock for limited availability in modern office space. So tenants are willing to accept long leases there, with the usual kind of, if you have a new building, 10 to 15 years. We see in some case that tenants try to get kind of exit clauses for parts of their space, so they can kind of give back some space after a period of 3 or 5 years or something like that, just to give them a little bit breathing room if kind of business plans don't work out, or they have a more significant shift to working from home than they usually or initially expected. But overall, if you look at the market average, lease terms have been and are staying quite the same.
Okay. If there are no more questions, then thank you very much. Thank you very much, Tobias. Thank you very much, Simon, for your lecture on this impact on working from home. I think it was great to see get more light on this debate, and there is some figures, and hopefully we will join us in the next 2 or 3 sessions of today. But thank you very much. And now over to Tobias, who will introduce our next session.
Yeah. Thank you very much.
Thank you.
Thanks to you both. Great session. I'll say it out to our alumnus, Andreas, who was a co-worker, and I remember correctly of this work.
Yep. He's on a vacation right now, so.
Yeah, I know that. So, thanks a lot.